Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to this episode of the Expansive CEO podcast. I'm your host, Hannah Chapman, and this is Investment Friday. We are back for Investment Friday with Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies. Hey, Brad, how you doing?
Doing well. How are you, Hannah?
I'm good. My family got back from vacation it was technically Saturday, but it was like midnight that we got in Saturday night, back to Cincinnati. So we went to Disney World for the first time. My kids are 13, 11, and almost 9. So this was their first time at Disney. And they had a really fun time.
Perfect ages for it.
Right. Yeah, they had a great time. We did a ton of walking. I think I wore my Garmin watch and it was like 100,000 steps basically. It was a lot. But what was hilarious was that when we asked the kids like what their favorite part of the whole trip was, one, swimming. So we stayed at one of the Disney resorts, like on the property, and they had a nice pool and with a slide and all, tons of people were there. So swimming was one of their favorite things at the pool. And when we went to Epcot one day, there was a mama duck
Oh,
with 4 little fluffy baby ducklings. Just literally,
oh,
just like a wild duck. It just was living there. And so it was in like they have little ponds kind of around. And so we sat and watched the baby ducks for like half an hour.
that's
all,
awesome, though.
all the things at Disney, right?
Yeah.
And yeah, one of their absolute favorite memories was getting to, because they were like close. They got to sit on these little rocks that were around the pond and be like feet away from these teeny tiny baby ducks. So, you
Oh,
know,
that's fun, though. I mean, that's typical of, you have a holiday and you spend lots of money on these different
oh yeah.
gifts. You stress out about finding the right gifts that they're going to have fun with. And when they're young enough, they end up playing with the box.
Yeah,
Yeah. Now,
basically.
yeah. So, but fantastic. Disney World, that's a wonderful place. It's a lot of fun. Did you go to any of the other parks other than Epcot and Disney World?
Yeah, we went to Magic Kingdom first, so with the castle, all of that. Then we went to Hollywood Studios.
Okay.
My husband and my son are both super into Star Wars, so had to go see Star Wars Land. Um, and that was pretty cool. And then we also went to Typhoon Lagoon, which is one of the water parks, one of the Disney water parks. That was one of the kids' favorite, was the water park. So yeah, of all the things we did, just all the swimming, the water park, again, Epcot. We didn't get to spend as much time in Epcot as I would have liked. I actually would have loved to see more of the gardens and the different things that they have there, than some of the other parks, but it had been a long week and everyone was pretty tired. So
Yeah.
we were,
Yeah, that's the thing is for the first couple days, kids can kind of hang. They do great job. By
Mhm.
the third or fourth day, they're starting to flag a lot because it's a lot of energy expended, a lot of
Yeah.
excitement, so they get tired.
Yeah. We definitely did our part in supporting the consumer spending. So,
Yep, supporting that Disney stock. I appreciate that.
right, go
Thank
ahead
you.
and pat myself on the back there, for pulling my weight, doing my part. So, speaking of, how are things going this week? What's the stock market been doing? We're in May, which the old adage is sell in May and go away, right?
Yeah,
How's that going?
that is the adage. That is the seasonality effect of, and depending on how you look at it, um, between now and the election, that also kind of lends to that sell in May and go away. I would suggest this year might be a little different. So the market is doing pretty well. We had a 5% very, very minor pullback. I know it probably seemed to people to be a lot bigger deal, but it was actually just barely over 5% pullback. And we've made up almost all of that.
Mm.
And so, the market has rebounded pretty significantly as investors have kind of repriced in the probability of interest rate cuts being a little bit further out than they had anticipated earlier than this year. And they started to assess, how are the higher interest rates for longer going to play out into the stock market? Which companies are going to be benefited the most, which companies are going to be hurt the most, and they're starting to make those assessments with their trades. And so as we stand here today, the market seems to be in a decent spot. But I would also argue that that means we need to be more vigilant as investors than less vigilant.
And to be perfectly clear, I have in my 17 years, I've never actually recommended anyone to sell in May and go away. Like that's never actually done that.
Yeah. No,
Just the
it's a terrible long-term financial planning strategy. So
yeah,
don't do that, everyone. But that is a Wall Street adage for a lot of traders back in the day.
yeah. Kind of some of those things that we've had passed down from generations ago, right? When you would actually, and just to go like back to like where that came from and what that means, right? Like everyone used to go in New York, used to go to the Hamptons, right? Or to the Catskills, in the summer. They would literally leave. And
Go on
so,
vacation.
yeah, because for lots of reasons, like New York was just sweltering and uninhabitable, not actually, but it
Pretty
was,
close. If
yeah,
you had
not a
enough money, you were out of there.
right. Anyone who had disposable income back in the 20s, 30s, they would leave. They would completely just leave the city. And so they would sell so that they didn't have to worry about anything and go be in their summer home for the entire summer and then come back in August, September and pick things back up. So we don't do that anymore. Clearly, our economy just keeps trucking along no matter what the season. Um, so yeah, that's where that came from.
Yeah. And this was before remote work and the internet, so you couldn't keep track of what was going on with your investments very easily. In fact, it was very difficult at that period of time, which is why people would then keep it in cash, earning a little bit of interest as opposed to keeping it invested. Now, today, with capital gains taxes, with the internet, with the ability to have financial advisors to help you guide you through it, it's not a great long-term strategy, but it's still with us in terms of a historic adage.
Right. And the summer it can be a little different here and there, right? Like we can have lighter trading volumes throughout the summer, which kind of makes volatility seem a little bit more pronounced. We might feel that a little bit more. But again, to your point, when you're talking about being in an election year, we actually haven't seen all of that yet either, right? More of that election year effect is going to start to show up later in the year towards, after the election and all of that. Tell us more about that.
Yeah, so usually, as we've just described in prior podcasts, election years are pretty decent years for equities in general. There's different variations if the incumbent wins, if the incumbent loses, and the complexion of Congress during that president's tenure. But in general, equities do pretty well during um, election years. The worst year of an election cycle, if you will say, is the second year,
Hmm.
which is to say is the first year that they're implementing their policies. And so uh, sometimes it's because if you get someone who turns over, right? Let's say a Democrat loses and a Republican wins. well, all of a sudden the first year is this is all the different things we're going to do. And regardless of the policy, any change is a risk to the financial markets. So the financial markets will, kind of wait and see to see how, if those policies get passed by Congress, how they get implemented. And so all of these things that create a environment of uncertainty, and that's what restrains financial market returns during that second year. Now, but the election year is usually a pretty decent year. This year has been really good, depending on how you look at it. The first 6 weeks was, more of the same in terms of the mega cap tech doing very, very well. And then basically since the beginning to mid February, the market has broadened out significantly to include small cap, some value factors and value stocks have really started to participate, and of um, that second tier of large cap also is starting to participate, which is great. That's what we need to see. That indicates a healthier market. So we'll see how that follows through.
So let's put a pin in that one right there because we're going to come back to it. But
Okay.
one of the other things that we talked about, and this will like bring that in together, right, is some of the labor statistics that came out in the last week or so. And in particular, some of the things that we're talking about with small businesses in the US economy. So tell us more about that.
Yeah. So the conference board puts out a meta index, which is a compilation of a lot of different indexes or indicators that track a particular event. Like in this case, it's the employment trends index that the conference board puts together. And what that does is it basically tracks a bunch of different indicators about the employment markets or the labor markets, and it determines how strong it is, how weak it is in a really broad based view. Um, Now that index is off about 7% from its high. Now, usually that index does not go down unless we're going into a recessionary period, unless things are looking so bad that we're going to go into a decent sized recession. It's gone down 3 times since the year 2000. Once was during the early 2000 when the Nasdaq cratered by 75%. That recession. The second one was 2008, 2009, the Great Recession. That also had it turned down pretty significantly. And then in 2020 with the pandemic, obviously it had that it kind of fell off a cliff during that period of time as well. But outside of that, it really doesn't go down much. Okay.
Mm,
Well, this is down 7%, and it's giving some investors and economists some pause to say, okay, are we really going to go into a recession, or are we just going back to trend? Because the labor market has been so tight. One of the big complaints from businesses, both large and small, is we can't find enough qualified employees, right? We have a really hard time. And when we do find someone, we have to pay up a lot, which is what's
mm,
driving some of this wage inflation that has been underpinning this sticky consumer price inflation. Um, so the more recent kind of decline is, in my opinion, right now, as it stands, is it's a normalization of the labor market in
mm,
terms of it's becoming more balanced. Now, from a very small business perspective, the National Federation of Independent Businesses, which is a trade group for very, very small companies, everything from sole proprietors up to 100 employees, that's their group. And they do a lot of surveys. And one of the questions in their surveys is, how many are you looking to add employees over the next 6 months? Well, that has fallen from 35%. We're going to net hire. It's down to about 11%.
oh, wow.
Okay. That's a good number. That's not at 35%, it's just too tight. right? All these businesses are competing for the same employee, and that drives up wages, which for a lot of small businesses, you can't really absorb that cost because generally your prices are a little bit, you don't have as much pricing power as, say, a large company. Um, so that I think is, again, signaling a normalization of the labor market. Maybe it's weakening, but it's weakening back to normal. Not, it's
Mm.
going from super tight to less tight, as opposed to in the prior times during the recessions was it was going from normal conditions to a lot of slack in the labor market where, okay, your unemployment goes up a lot. People are actually out of work. So now they need to find new jobs. Whereas we're going from super, super tight to probably more normal conditions at this point.
Mm. So super interesting there. And we talked a little bit more about this, the NFIB, um, before we started recording. And I wanted to point out one of the things when we go back to talking about stock market and whatnot is that the stock market as a whole and what we talk about, those are the biggest companies, especially if we're talking about the US stock market in particular, if we're, the S&P 500 or the Dow Jones Industrial Average, those are American companies. And S&P 500 in particular is the 500 largest companies. In the United States, there are over 30 million small businesses in the United States. And so when we think of the S&P 500, right? Like let's really like take a step back and understand what we're really talking about when we're talking about market movement, even if we're talking about the Russell 2000 or the Russell 3000, right? We're talking about thousands of companies when our economy is really based on these 30 plus million small businesses in the United States. Small businesses being, like you were saying, those businesses that are sole proprietorships or, up to but less than 100 employees. Think about I think about a lot of my clients who, are sole proprietors or have a few employees. And when you think about a business with 100 employees, like, dang, that's actually a pretty good sized business for a
That's
small business.
sizable.
Yeah. Yeah. And that, when we talk about small cap, when we're talking small cap, mid cap, large cap, different kinds of stocks, small cap goes up to $2 billion in revenue per year. And so I know, like, when we're talking about like hundreds of thousands or, a million or a few $1 million of revenue, like that can be a really stable small business, but it's not 2 billion in revenue
No,
and still small, right? So like,
no, I mean it's I liken it like unto your convenience stores. A lot of those are owned as franchises, right? So you
mhm,
have a local owner that may own one or two, and those each do 2.5 to 5 million in revenue. Those are small businesses, and they can be great businesses, but again, it's very, very different than Tesla.
right.
That is, you know,
Or Meta or
depending on the day,
Google.
yeah, or Google or Microsoft or Albertsons store or Kroger's or Walmart. Very, very different type organizations with very, very different types of concerns. Um, so it's important to understand. It's why people always say small business is the driver of innovation and it's the driver of jobs in the United States. And that is absolutely the case.
So the reason I wanted to like mention that and to talk about that for a little bit, I think it's really important to kind of illuminate that or talk about that a little bit, like what when we're looking at economic factors, when we're looking at um, the experience that people are actually having. I talk about that a lot on the podcast, right? When we've got, here's the investment side of it. Here's how the markets are moving. Here's, macroeconomics um, in the US and globally. And then at the same time, people just normal, everyday, people in the US at least, might be having a very different experience than what we talk about in, macroeconomic scale. And so, how do we, I guess the question here is, how do we move into a place where we can take this knowledge in the investment side and start having allowing more people, allowing greater participation into that wealth building cycle, right? And I think as I say that, like, oh, that's what I do. Um,
It
that's
is what you do,
literally
but
the job that I do.
yeah,
But let's talk about
but
it.
yeah, you bet. To the point that I'll give you an example. I have a client. The client's underlying business is very uh, economically sensitive. Okay. So, in because he generates all of his cash flow on a year-to-year basis and funds his investments and savings from this economically sensitive business, you don't want to dual dip the same thing.
Hmm.
You don't want to give him a portfolio of all these economically sensitive stocks, because what happens is now you've exposed him twice to the
Hmm.
same risk factor of economically sensitive cyclical businesses. So what we did is we created an equity portfolio for him that was less sensitive to the overall economy. And so he doesn't have to worry. He does get that diversification from his underlying business, because that's where he's generated all of his wealth so far, and eventually he's going to sell it. He's not going to pass it along to any heirs, so he's eventually going to sell it and fund his business. At that point that he sells that company, we then can take that portfolio and broaden it out to include economically sensitive stocks. But at this point in time, what we do is his we take how much this business would be worth, and we make it offset with different risk factors, different return drivers that aren't necessarily determined upon what the economy does.
Hmm. Yeah, I think that's the piece, especially for business owners, entrepreneurs, and people who are generally very sensitive to market volatility, right? I think that goes for all of those groups in particular. Um, that being able to find places to invest that are generally more stable in one way, shape, or one way or another. Whether that's dividend producing stocks or you know, bond ladders that make sense for them, and tied to the higher interest rates right now. Like there are ways that we can create portfolios that match your actual need, versus just, you know, throwing it into the stock market and hoping for the best. I think that's what I see a lot with new clients who have, um, maybe they've tried on their own. They have a brokerage account. Like, well, I don't know. I just tried to pick some stocks, and I look at them sometimes, and I don't know. I've actually seen that a lot more recently. I think with the advent, or the um, different things like Robinhood and Acorns and other platforms that are trying to make it easier for people to be investing. But then at the same time, there's not the education or the knowledge around how to do that effectively.
Yeah. Um, I think I'm going to make a controversial statement here.
Let's hear it.
Uh, I don't think investor returns have been helped by do it yourself. And the reason why is because they have taken investing, and they have made it, they try to hit the easy button, which I understand they want to do for the average investor for the beginning. Um, but they don't provide the education that's necessary. And so what happens is you have people that get into the market. If they have immediate success, they think they're geniuses, and eventually they're going to learn that investing is a little more difficult than that. They're going to have a hard lesson. If they get in and they have a bad experience right away, then what it does is it turns them off from
Mhm.
investing altogether.
Yep.
So I think do-it-yourself investing for people who are very interested in it can be great. I've got a lot of clients that I've encouraged to have their own little account where they invest in their own ideas, which I think is phenomenal. Some of them have done extremely well on their picks, but these are people that this is what really gets them excited. And the reason they hire us is because they don't want to worry about their lifestyle bucket. They don't want to worry about that if their stock picks go down, they can't pay their lifestyle. So we take care of all that other stuff, but the ones that get them out of the bed in the morning and that they're really excited about, I mean, good for them. That's awesome. And I help them as much as I can, as much as they want. But generally, they can do it on their own. However, um, one of the things I think is happening right now is um, passive investing. Obviously, over the last basically since the 1970s, passive investing has become the rule of the game, right?
Mhm. Which
And
means
unfortunately, I
index, like index funds.
yes, index funds, uh, ETFs that are just passive.
Mhm.
Um, we've had a lot of money go into those areas, and that's great, except that we get to a point where there's saturation. And what happens is stocks that are out of the index are much less efficient, i.e., they provide a better opportunity for excess returns, so higher returns than the ones in the index.
Mm.
And so the index overall will go up and down with generally whatever the economy does. Whereas these other companies, it leaves this huge chasm in value. And that's where we're starting to see, you know, small caps, I know I've mentioned this a few times, are trading at massive discounts to their large cap brethren or sisters. They're trading at a massive chasm, very, very wide. On a standard deviation basis, it's pretty extreme. And eventually that has to correct. Because as we said earlier, small caps are closer to those independent businesses, and small caps, including with those, they generate a lot of the innovation in this world. Um, Large companies rarely over a long period of time generate those innovations. Generally, it's small caps that the large companies will then come along and buy
Mhm.
before they get too big.
Right.
Um, and they absorb them and then they use the technology, which is great. But the fact of the matter is we have these large companies that are so large now that to get 10% growth on those stock prices, you're adding another mega cap onto those companies. And it's just a very difficult from a math standpoint, regardless of any of the economic underpinnings, from just purely mathematical to add 10% onto a $1.5 trillion company is $150 billion.
Mhm.
Okay. Not impossible. You can do it, but the probabilities you're starting to reach the top level, there's a maximum there somewhere that you're going to outstrip your earnings and your earnings growth. And so what happens is you have to start going to the smaller companies, whether it's a second tier large cap or small mid cap or small cap, that maybe not as many analysts follow them. Maybe people don't understand their business quite as much as as it should be. And that gives an opportunity for active managers to step in the void and to really outperform over a longer period of time. And I think we're getting to that point. You see this bifurcation between people doing index funds and private equity. Well,
Mhm.
private equity is the epitome of active management,
Right.
right? So and they pay and they charge a lot in fees. So you have both. You have people that are indexing and they're very passionate about buying index funds because it's cheaper. And
Right.
yet
Very,
then
very
they
low
go,
fees.
yeah, very low fees. And then they go and they pay 2% plus 20% of their profits to a manager that may or may not do well in private companies. And so to me, it's like that makes no sense if I could do it in the public markets for much less expensive.
Yeah, that's super interesting. Because some of the conversations that I've had and the things that, when I've, talking to people who are more do it yourself, uh, I have had conversations with people who are like, we want alternative investments. We want to be able to look at like private equity and REITs and different things like that. We don't want just, your run of the mill investments. And when they ask about like, well, what does that cost? What are the fees? I'm like, it depends on the thing that you're looking at. There's no way for me to even tell you what it's going to cost because the performance fees are whatever that manager wants them to be. And when we talk about private equity or REITs or hedge funds or anything else in that realm, the performance fees can be really, really hefty. And so it's very interesting that you say that, because those are the conversations I have had with people who have mostly done it themselves or, mostly done index funds, passive investing, and then want to jump into something completely different. Or even, real estate and house flipping and things like that. I'm like, well, it's super active.
Yeah, I mean it's
You're doing a lot of sweat equity there.
yeah, yeah. In real estate, you got to pick the building, you got to pick the property. So that's it's an interesting dynamic because people that will spurn an active small cap manager, they'll say no, that's too expensive or whatever, and then they'll go for a private equity fund. Now, what's interesting to me is the overall private equity and hedge funds have not done well from a performance standpoint, which is why they present it as a risk diversifier,
Mm.
which I think it can be. I think it's very you have to be very selective on how you do it. And I think that a lot of people own the feeder funds, which is kind of a fund of funds scenario where you have 100 hedge funds underneath this one fund that you own. And the problem with those are you're diversifying away all of your excess return from because you may have 20 really great hedge fund managers in there, and you have 80 that are just okay or not great. And these 80 are going to take away all the excess return from the top 20. And then you layer on that fees from the hedge funds themselves and then the feeder fund level. And to me, it's just a very, very expensive way um, to get a low return.
Yes, I hopefully it's not super loud, but my dogs are barking downstairs. You can't hear. Okay, that's
Can't
great.
hear them. Nope,
So
you're good.
someone is riding a bike outside and it's not helpful. All right. Everyone freak out about that. Uh good. I'm glad that was not what do I want to say? Disruptive. Because as I'm listening to you, right, it's really, really important again as we talk about like how can individuals get into the market, how can individuals actually take advantage of and be a part of growing your money in this way. It's really, really important to have information that you can trust and to have um access to someone like you or someone like me where we can talk about your options and like what actually makes sense and what you're actually going to pay and what the potential returns might be. And we'll kind of wrap it up with this, but we had talked about before, we've talked about PE ratios, which is price to earnings ratios, um, and how on the mega cap stocks right now, all the top, 8 to 10 stocks in the S&P 500, their PE ratios are really, really high. It's really expensive to get into to buy those stocks right now relative to their expected earnings over the next several years. And so when we look at that, like if you were to buy Google or Tesla or Apple or, any of those right now, you're going to get in at a high price point. And while they may grow over the next 5 years, it might be, turtle growth over the next, like, yep, they're doing their little incremental because there's not as much room to grow from where they're at versus some of these stocks that are um that haven't exploded in the same way, and they have more room for growth. And being able to, again, talk to someone who knows more about that, can just it can make a big difference in what your actual returns end up being over 5 years and 10 years and 15 years than if you get a brokerage account and buy your top 5 favorite stocks and just see what happens.
Yeah. I mean, I would agree with you. I think it's important for people to understand the context of today's market where, those top 8 stocks, the average P is 45. So for every dollar in earnings, you're paying $45. Whereas in the small cap space, I'll give you kind of an idea. It's right now about 15.
Mm,
So it's a big difference.
yeah.
Um, Not to say that's good or bad. I'm just saying over time that adds up a little bit differently. And these things are not timing indicators. We're not saying, hey, this is going to take off tomorrow, but it is somewhat of an indicative of future returns over the next 5 to 10 years that generally things with lower PEs will outperform over a longer period of time. It's interesting because one of the founders of GMO, Grantham Mayo, he uh, he said, a you, you want when you invest and you take cash and invest, you want unemployment to be high, you want the market to be falling off a cliff, you want the economy to be suffering. That's when you want to buy.
Mhm.
When everybody starts to feel good about their investments, the economy, low unemployment, wage growth, he goes, that's the time where you need to be not necessarily selling, but you need to be just aware of the context of the marketplace and that there are some downside risks to that as opposed to when you buy it during you know, a massive bear market, things don't have to look that much better for it to go up in price. Whereas right now, things have to be looking really good for it to go up in price.
Yeah. Super interesting. Well, I want to make sure we don't go super long today, because I think we could absolutely keep talking, especially since we haven't had one of these in a couple of weeks. But for today, I think that is a good place to wrap it up. And as always, we love, love, love to get your questions. And if you have anything that you've been thinking about, wanting to, hear from a CFA and a CFP at the same time, on any of these topics, you can certainly reach us. You can reach me at Hannah, HANNAH, at expansiveceo.com. At, yeah, that's right. At Expansive CEO, Hannah at expansiveceo.com. And you can get Brad at,
B Haines, BHAINES at juncturewealth.com.
there we go. That's how we talk about emails. Had a total brain fart there for a second. Right. The .com does go on the end there.
You still
So
have Disney brain. That's okay.
still, yeah, I don't know. I got a little bit sunburned. Um, maybe that's it. But anyway, it was so good to see you again, Brad. Happy to be back. And we will talk to you again soon.
Sounds good.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.